Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 35, and it is also part 5 of how to execute lease options the right way. And so today we're going to continue where we left off from the last episode, which is deal analysis, aka finding money. I think this is usually the most exciting part. Sorry, I'm just adjusting my screen here because it seems like it's picking up funny stuff. So this is the part where I usually say is one of the most exciting parts. And the cool thing about this particular strategy is that you can actually run these numbers really, really early on, because once you understand the framework, you can actually start to project the moment you have your first conversation with your potential tenant buyer. And so I'll wrap it all up later on as we are starting to conclude the strategy. However, today, I'm going to keep going here. So if you remember, based on yesterday and what we went through, where we left off is based on an option to purchase price at $650,000 in 3 years' time. Okay, we came up with the conclusion that the total option consideration is $65,000 based on 10% of final total option consideration accumulated. And here's the thing, if you're learning this strategy, I want you to make sure that your language is very, very clear for legal reasons. And this is why I always emphasize with all the Trust Your Talent Academy students that if you are leveraging this strategy, the only time you truly will steer away from the technical lingo is when you need to just be more relatable and being able to communicate things properly, meaning most of the times it's during your marketing process, okay? And so the reason why I'm stressing that again is simply because of the fact that, remember, it's lease with the option to purchase. And so all the money that they are contributing towards the option to purchase agreement, it's called option consideration money. And so this is why I also want to encourage you to write this down or listen to it a few times, okay? I always say that when you're sitting in front of the tenant buyers and you're explaining this process to them, the one thing that you need to be very clear about is you need to let them know that meaning if I'm talking to you as a potential tenant buyer, your total option consideration will turn into your final down payment. Okay, I want you to hear that properly. Your total option consideration will turn into your final down payment when you are qualified and choose to exercise your option to purchase. Okay, so I want to say that again and again and again over the next few episodes, just because this is extremely, extremely important. And within this one sentence, one very long sentence, there are actually 3 different components as well. So hear it properly, okay? Your total option consideration will turn into your final down payment when you are qualified and choose to exercise your option to purchase. Okay, these 3 components, you cannot miss any single one of them in order for them to go through as a successful tenant buyer and a successful lease option executed. Okay, it's kind of similar to the 3 factors that we talked about. There's also another 3 factors right here. So remember that for yourself. Okay, so going back here now, we've now determined that there's a total option consideration of $65,000 because we're stress testing our own deals. Because what happens if the government comes out and says, oh, by the way, 5% is no longer enough because of the inflated value of the Canadian market, and we need to do something about it. And so this gives us a lot of leeway. I highly doubt the government is going to do that anytime soon, or even if they do make that change, if they're going to double it like we do. So they could change that number a little bit. However, the point is, we got to the point where we calculated our monthly option consideration of $903. So if you remember now, going back to a couple of the episodes that I did before called the top priorities of real estate investing. The first priority is what? Cash flow. Okay, cash flow. Remember, educated investors are performance-based investor, and that means first and foremost, you have got to be in the green and in the positive on a monthly basis. Okay, I know in other strategies, it may not be the case, and that's okay too, as long as you have a forecast date or end date to negative cash flowing or to your deal not cash flowing. Okay, however, in this particular case, remember when we first started, we say that when you execute this deal right, you basically will be cash flowing from day one. Okay, you basically will be cash flowing from day one as soon as you take possession of the property. Depends on your business decision. You might actually have a couple of days of buffers. However, you typically should be cash flowing from day one. So what that means is the next step now is for us to figure out cash flow. Okay. So cash flow, first thing first, basically is a fancier way or a street way, I don't know how you want to call it, of saying, is this particular deal making a profit on a monthly basis? And how do we measure profit? Business 101, revenue minus expenses. Okay, so revenue minus expenses. In this particular case, revenue typically will have two streams. The first one is fair market rent. Remember, lease with the option to purchase, and option to purchase is their monthly option consideration. And yesterday we said monthly option consideration is $903 on a monthly basis. And fair market rent on a property that's $650,000, okay, on a property that is $650,000, 3 years from now, we also need to figure out approximately how much that property is worth today. Okay, so follow along. If you're gonna grab your calculators now, I mean, I know some of you are just listening to this, and that's okay too. Just follow along with the thought process. I'm going to use my home market as an example, which is Edmonton, Alberta, here in Canada. Okay, so looking back at the last 15, 20-year average in terms of real estate value, we know that on average, this market goes up by about 3 to 4% on an annual basis. And that is a cumulative average, okay? So I know to some of you, that's like, wow, that's a lot. To some of you, that's like, are you serious? It's one of the major cities in Canada, and you're only talking about 3 to 4% increase per year. If you're from other major cities, then you understand that this is not a very typical city. And this is why I'm forever grateful for actually starting my real estate investing career here in Edmonton, simply because of the fact that this is what we call a sideways market a lot of the times. I mean, we're very much boom and bust because of the economic cycles that have largely been based on oil and gas. And so as a result, this is why I'm very grateful, because I really learned and really embraced the concept of a performance-based investor mindset. And so with that said, if we're going to say, let's just take an average, okay? Let's just take an average. If the average increase is 3.5%, okay, what you would do is 650,000, because that's the value 3 years from now, okay? I'm gonna divide it by 1.035 3 times. Okay, so divided by 1.035 and then divided by 1.035 again. And then you're going to get a number that looks like this: $586,262 and about 76 cents. What I'm going to do is I'm going to, oh, that's weird, seeing myself 3 times here. So 586,000, I'm just going to round it down quickly. So for easier math. Okay, so what does that number represent? That number represents what we call the current maximum purchase price for us as investors. Okay, 586,000. So that number is important because in the next episode, we're going to come back and revisit what that means. Okay, so 586,000 is today's value or maximum purchase price, okay? Or maximum purchase price. And so as a result, what we have now is You have a property that's worth about $586,000 today. And in my home market, okay, assuming that that property is sitting in a decent B plus or A minus neighborhood, okay, typically working class and their combined household income is usually about 90,000 or higher. In Edmonton, it's actually higher than that. However, what that also means is these tends to be decent working class neighborhoods, if not a little bit better. So these type of properties are very typical, and they're what I call your 3 bedroom BD, 3 bedroom, and then 2.5 bath houses, fenced in with a double garage attached or detached. And this is typically what we call a detached property, meaning it's not a condo, it's not a duplex of any kind, it's not a joint, they don't have adjoining walls with any other units. Okay, there's a fenced in backyard because most of our tenant buyers, they may have kids or they may even have pets. Okay, so in this particular case, this type of property in our current market rents for about 3,000 all the way to about 3,400. Depends on the neighborhood, the condition of the property, the age of the property, and the appearance of the property and the perceived value. Okay, so again, fair market rent and fair market value, they're very, very similar in the sense that it's largely determined by supply and demand. It's very much determined by the market, and any sort of fair market value of anything, because fair market rent technically is a type of fair market value number. And so how that's all usually determined is willing buyer, willing seller coming together. And in this particular case, because we're talking about fair market rent, so it's willing renters and willing landlords coming together. Okay, and usually because we do this number and we fix the lease for the entire duration of the rent to own or lease option program, we typically don't actually go through the annual raises. Okay, we typically don't go through the annual raises. And this is why this is another part where you will make your own business decision. Okay, you'll make your own business decision so that you determine if you're going to take 3,000 here or 3,400, or some people will say, I'm going to do the average of the two numbers of the range. So they will fix the rent in this case at 3,200, 3,200 on a monthly basis. Now, our business decision, typically speaking, is that if currently there is a high at 3,400, chances are even if we start at 3,000, based on the annual increases in rent percentage, we probably will hit that. Okay, we probably will hit that, if not exceed that, 3 years from now. And so we typically will go on the higher end, but not max it out. So for demonstration's sake, I'm going to say my business decision is 3,300 right now, and then I'm gonna add the 903 to it, which means at the end of every single month, what you're collecting from your tenant buyers on a monthly basis is 4,203. $4,203. Okay, $4,203. In today's world, based on the interest rates that we're seeing, this number actually doesn't really shock anybody anymore. So in any market conditions, you're going to have different challenges. Why? Because 4 or 5 years ago, when we were executing this deal, even just 2 years ago, when we were executing this kind of strategy, a lot of the times potential tenant buyers will look at that number and go, hang on a second. One of my friends or one of my coworkers just bought something that's $800,000-$900,000 and their mortgage payment is not even near that. Well, that's because of interest rate. However, these days, even if you buy a $400,000 or $500,000 house on your own, where you have to come up with 5 to 20%, and you still have to pay property taxes, you still have to pay insurance, your monthly payment is definitely way more than 4,203. $4,203 on a monthly basis. And here is also where they're going to challenge you. And so that's why I sort of gave you the thought process about if they were to able to do this on their own without you, their monthly payment is already way more than that. Okay, first thing first. The second thing about that thought process is also the fact that we sometimes call this program, a lease option program, a homeowners in training program. Homeowners in training, because we've seen people that don't execute it properly and all they want is to flip tenant buyers. Remember how I talked about that? And that's not something that we want to do. Okay. And so the idea behind this is that we want to make sure that during their lease option period, their monthly commitment, their monthly payment is close to, if not higher than, what their monthly payment potentially will be when they take over, so that they don't get the sticker shock. Okay. And they don't all of a sudden become completely house poor or even house broke after they take over. And then all of a sudden, they're not able to sustain those payments. And as soon as they take over, they actually have to either sell or they go into foreclosure. That's not what we want at all. However, I've seen a lot of lease options providers out there over the years that they will say and do whatever it takes, because even if they just have a little bit more cash flow than average, they will just do it and put a tenant buyer in there with no goals and plans to actually help them succeed. And I always say this: there are bad students in good schools too. There are bad students in good schools too. Think about that. And when I heard that expression, it really hit home, because every single strategy, every single profession, you're gonna come across frogs until you find princes and princesses. Okay, and so it's the same thing here. The point is, when you learn how to do this from me, from Trusted Talent Academy, I'm gonna teach you the way that has not only allowed us to create numerous and countless success stories, not just my portfolio anymore, it's now the entire community as a whole. It also is the best way for you to help others, and you set people up to succeed rather to fail. Okay. And so I want to make sure that that is very, very clear there. And when it comes to expenses, I'm going to just speak to that, and then we're going to complete this at the next episode. When it comes to expenses for lease options, we count PITI. It's what we call a pity payment, because it's such a pity that, you got to pay money to make money, because that is the world that we live in. However, again, the next topic is likely going to be creative financing, and that's one of my favorite ways to approach things. Okay. However, PITI basically stands for principal and interest. Okay. So principal and interest, and that's usually your mortgage payment, because most of the times, mortgage payment, because most of the time, when you're buying a property leveraging traditional lending, your monthly commitment is usually principal and interest payment. Very rarely do you actually get interest only. I mean, if you get to choose that, that's completely a business decision. If you want, we can also take a look at how that changes the numbers at the end of the day. However, the idea here is based on this, because later on we're talking about income properties, and the formula on how to calculate cash flow, it's going to be massively different. And why are we only counting pity payments? Okay, I know some of you might be making the business decision of still budgeting in repairs and maintenance. It's completely up to you. However, when it comes to lease option, you got to remember, as very much how we started this entire topic, starting episode 31, which is the fact that we call this a homeowners in training program and a worry-free rental program, meaning the type of renters, because you're not getting typical renters in here anymore. You're getting people who will go through the rental process. However, the ultimate goal is to own that property out and to buy you out, which means the sense and the pride of home ownership that they have, very, very different. Okay. And also from an agreement standpoint, we can also put in there what they're responsible for. And that again is another business decision, because we have investors who said, okay, you know what? I'm still going to budget in quite a bit for repair and maintenance just because that's the way I run things. We also have investors who go, well, again, if it's an alternative lending strategy, what that means is I'm their lender. Okay. I'm their lender first and foremost, not their landlord. So that every single repair and maintenance issue is 100% passed through and passed over to the tenant buyers so that they're responsible for all of that. And that is completely up to you because, again, I'm giving you the spectrum and you decide based on your own risk tolerance, based on your own style, and based on your own business decisions on how you want to run things. For the most part, like I said, we will do pity payment. Some of you might be doing more. And again, we're not big fan of condo buying. Remember, condo buying is not typically considered investing. Okay. However, in certain cities and markets, I know at times you may need to just because of the numbers and the value of the properties. And I will usually say this at this point in the training is that if you have to go into condos or townhomes in this particular case, I typically encourage people to look at properties that are between 3 to about 6 years old. 3 to 6 years old. Why? Because from year one, when the condo building is brand new or a townhouse is brand new, the condo board typically is still figuring things out. And a lot of the construction defects may not have shown up yet. Usually the condo fee stabilize by about year 3. And then year 7 and above is when these properties, or most properties for that matter, start to see the normal wear and tears, and maybe there was some minor construction defect, but after about 7 years, they start to show up. Okay, and then they might start to cause bigger damages. As a result, special assessment fees that will eat into your entire profit margin. So there, in my opinion, is a bit of a sweet spot. 3 to about 8 years, okay, is where you want to be looking at altogether. And by the way, by year 7, year 8, that's when you are thinking about exiting. So if it's a 3-year program, what that means is you might be looking at anything that's considered a condo no more than 5 years old. I'm hoping that that makes sense. And if you want to use a 7-year mark, no more than 4 years old. Okay. And so on that note, that's completely a business decision. You get to decide how you want to run these numbers. And so with that said, hopefully that starts this portion. And I know I'm kind of leaving a bit of a cliffhanger here because we haven't actually completed the cash flow calculations yet. That we're going to continue at the next episode. At this time, I want to invite everybody. I know this is short notice. However, if some of you have already been following the Eventbrite page for Trust Your Talent Academy, tomorrow being Saturday, June 24th, we are running our next online live boot camp. And it doesn't matter where you are because it is online and it is live, meaning you're not just going to go on there and watch a boring recording of anything. And in fact, this is a 6-hour session, okay? And it starts at noon Eastern Standard Time, So it depends on where you are in the world. That actually means 5 p.m. UK time and 10 a.m. Mountain Time if you're like me, and any other parts in the world. You are able to register, and I would highly recommend you to actually go through the bootcamp so that you can learn all the strategies and get introduced to them. And for a lot of you, if you've already got a portfolio going, one of the biggest feedback that we got is this is actually truly back to basics. It's given them a lot of aha moments on how they can actually tweak the performance of their portfolio and continue to scale their portfolio as well. So I'm going to be putting the Eventbrite link in the comment section again for your convenience. So if it's something that you can make the time to do, I know it's short notice, so don't feel bad. There will be more coming later on. However, probably another 3 months before we put on another one. So make sure that if you can make it, get yourself there, and we'll see you at the bootcamp so that you can ramp up and build some momentum and speed for yourself as well. Because these episodes, I know they're long and short all at the same time. There's only so much I can do within about a half hour mark. Remember, the goal was always to be about 15 minutes. And yet, almost every episode has been about 20 to 30, just because I want to make sure the context is built properly. Okay, so with that said, It is the last episode of the week, and I will be back here next Monday. My Daily Dose with Tim will come to you at noon Eastern Standard Time every single day during the week from Monday to Friday, and that means 10 o'clock Mountain Time in the morning and 9 o'clock Pacific Time. And I am so grateful that you have chosen to stick with me. And I feel like I'm just getting started, even though it's 35 episodes in already. So with that said, have a great rest of the day and have an amazing weekend. I know I'm going to see some of you tomorrow at the boot camp, and live well, everyone. I will see you back here next week.